Hi, I'm Rob Bloomfield, and this is Accounting with Our Bare Hands, a series of videos exploring the mechanics of cost accounting. The topic of this video is two-stage costing, and it's the first one in which we don't have any debits or credits. All we're going to be doing is exploring a better way to calculate predetermined overhead rates and determine how many dollars of cost will be applied to each individual product or service for overhead. Okay, so this is essential to and a better way than we've seen so far in isolating margins, figuring out exactly how much profit we are earning from each of our products and services. So I've got a very simple example. We'll stick with our glove company. I'm just going to use some slightly different numbers and some different assumptions about production. I'm going to start by assuming that we have a total of $1.2 million in overhead. Now, this circle here, this is called our overhead pool, and one of our first goals in cost accounting is to make sure we can calculate a predetermined overhead rate that will get all $1.2 million of overhead into our products, assuming everything goes as projected. Okay, so I actually like to draw that this way, where you can think of this pool at the top, this overhead, it's like a pool of water, and the water is going to drip down into all our products. Every time we use a little bit more of our overhead driver, we're going to take a little bit of money and it's going to drip down into our products. So how do we calculate the rate? This is the way we've done it so far. It's often called simple overhead allocation. We just have one driver, and so we take that 1.2 million and we divide it by our activity base, which I'm going to assume is 400,000 direct labor dollars. And if we divide 1.2 million by 400,000, what we get is 300% of our direct labor dollars as an activity base. As a predetermined overhead rate. So let me just spend a moment talking about this in a slightly different way. We've already discussed in a prior video on overhead application that, every time you spend some money on your workers, right? You give the workers some money as a product manager. You also owe headquarters some money as well, because they've given you all of these overhead resources. They've given you rent and utilities and management supervision and expensive machinery that is depreciating. All of these things cost money. It needs to come from somewhere. Now, you haven't seen a rate as a percentage before because you haven't seen me use an activity base of dollars as opposed to hours or something like that. I chose to use that in this case because I want to make a point, which is you can think of predetermined overhead rates as being like taxes. Just like a government needs to collect taxes in order to pay for roads and bridges and military and whatever else governments need to pay for, your business needs to collect money from its product managers for the rent and utilities and depreciation and so on. So you can see, boy, this is a mighty high tax rate. For every dollar you pay a worker, you are paying $3 to headquarters for the costs of all those shared resources, the resources that are hard to distinguish. When you pay the money, you don't know which particular job it's for. That's why it's overhead. That's why it's also called indirect cost. And now I'm going to introduce yet another term. It's also called burden. And you can see now why it's called a burden, because we are placing a very heavy burden on labor. Every dollar of labor costs the product manager that dollar plus another 3. Now, to get all these right, if everything goes as planned, we're going to be putting, when we look at a particular product, we're going to take the direct labor dollars that go into that individual product, and we're going to tax it at 300%. So if you think about and then you add up, right, if all our direct labor dollars are what we predicted, 400,000, and we actually incur 1.2 million as projected, then that 400,000 times 300% will get us right back to our 1.2 million. Let's think about just an individual product, and we'll keep our math easy. Imagine we have a product that has, so we have a batch of gloves. It takes 100 direct labor dollars. We are going to tax that at 300%, and that's going to give us a cost, an overhead cost alone of $300. Okay, so this is really, it's a different visual representation, but it's exactly what we've done before, just a slightly different driver. Instead of direct labor hours, as we saw in some other videos, we have direct labor dollars. Now let's look at two-stage costing. Okay, two-stage costing is when we say, we're using this one driver here of labor, but I don't think that all of our labor dollars are actually, all of our overhead is actually driven by labor dollars. And think about it. Imagine you have an example where some of the gloves you make have to be hand sewn, and they take a lot of skilled labor, so a lot of labor dollars. And others are fairly generic. They're sold to lower end outlets like Walmart and Target, and they're done on machines. And so they have very few labor dollars, but they actually consume a lot of overhead because of all the depreciation on those machines. So here's how businesses handle that type of problem. They use two-stage costing, where the first stage is to split that pool of $1.2 million of overhead into two separate pools. Okay? And I'm just going to assume that the first one, which is associated with labor, has $400,000, and that leaves $800,000 that is overhead really driven by machines. Okay, so we often call this labor-related overhead and machine-related overhead. And let me just give you a little more of a story here. As I mentioned, there are highly skilled laborers primarily working over here, working on high-quality products, going to high-end outlets, Saks Fifth and Bloomingdale's and so on. And then you think, well, all that labor, what type of overhead is the labor driving? Well, you probably have a lot of supervision. You probably have benefits, healthcare benefits, and so on. You've got training. You've got a human resources department that has to keep track of labor. Workers may take a lot of space. They need offices. They need computer accounts. All of those things are overhead because at the time that you incur them, you really don't know what particular contract they're going to be working on, and so you don't, it's not a direct cost, it's an indirect cost. On the other hand, every time, with the machines, right, they really drive a different type of overhead. The most obvious is you've got a bunch of depreciation on the machines themselves. But they also take space. They take a lot of utilities. You've got to run them. You may need to cool the room that they're in. There's maintenance. You may have an engineering staff that does work that's associated with the machines. And so, again, this is overhead because at the time you do maintenance, right, on a machine, you don't know which particular job it's for. So now we're going to do basically the same thing that we did before. I didn't want to narrow that so much. Hopefully this will still be legible. Right, we now have, we've gone through with the accountants and the engineers and the managers and the production staff, and we made the split of the 1.2 million into 400,000 and 800,000. And now we can do the same, right? We haven't changed our activity base. We still have this, this $400,000 of overhead divided by, so the new overhead pool size, it's smaller, but it's divided by the same 400,000 direct labor dollars. And that gives us a new rate that's only 100%. Now, I say only because it's lower than 300%, but recognize still $1 of direct labor costs you $2 because you pay $1 to the worker and you pay $1 to the headquarters for training your workers and hiring them and giving them computer accounts and all that. Now, on the machine side, how are we going to allocate the $800,000 of machine costs? We're going to have to add a new driver that we haven't measured. And so let's just assume that what we do is, maybe we have RFID tags. It's all computerized, or maybe people have to punch in a number when they start working on a machine that indicates which job it is, and when they're done, they punch another number. However we record it, how about we keep track of machine hours on a job-by-job basis? So I'm going to assume that we expect in total that we've got 2,000 machine hours over the period. So we're going to take this $800,000 of machine-related overhead. We're going to divide it by 2,000 machine hours, MHRS, and that's going to give us a rate of $40 per machine hour. Okay, so every job, every hour that a machine is running for a particular job is going to add $40 to the cost of that job. Okay, so now let's fill out our general calculation here in the box, right? So we still have to get the 1.2 million to drip down, right? So now we've got, you can think of this as like one of those fancy fountains in a hotel where the water's up at the top in one big pool, and then it drips over into these other pools, and then drip, drip, drip down into each product at a rate of the direct labor dollars at 300% plus the machine hours at $40 per machine hour. Okay, so that's how much a product will cost. So, now let's go back. We have our particular batch of gloves, and before it was enough to know that it had 100 direct labor dollars. Now we need to know how many machine hours it had. So let's just say that job had 100 direct labor hours and 100 direct labor dollars and 3 machine hours. So how much cost is it going to get? Well, it's going to be 100 direct labor dollars at 100% plus 3 machine hours at $40. And if you add that up, okay, so 3 times 40 is 120. We've added another 100 here of labor-related overhead. So that's 120 plus 100, or 220. Okay, wow. So what do we know now? When we changed the accounting system, the reported overhead cost of this particular job dropped from 300 to 220. Is that always going to happen? What made that happen? Well, let's use another example. Let's say that it has the same 100 direct labor dollars, but instead of only 3 machine hours, it has 8 machine hours. Well, 8 times 40 is 320 plus the 100 for labor, so that's going to get us to 420. Okay? Well, what's going on here? I think the easiest way to understand this is to think in terms of taxes. Okay, so our old tax rate here, right? I just want to emphasize again, right? We're going to be thinking about our business headquarters as being like a government. They've spent all this money on labor-related support and on machine-related support, but under the old tax system, they were collecting all of their taxes on the basis of labor. Okay, so it's kind of like, imagine you have a small city or something, and they, they're just looking at income. It's the only way they collect tax is by income. So who's going to pay a lot of taxes? The people who are currently making a lot of money. But the people who have a lot of property are getting away with it, right? Property's not being taxed at all. It's being sort of, given away for free. You can imagine not everyone's going to be happy about that. And who's going to be especially unhappy? It's the people who have no land but are earning lots and lots of money right now. They are getting socked with very high taxes. So now what's happening? Right? The firm is saying, wow, this really isn't fair, it's not accurate, it's not really encouraging people to do the right thing. So we're going to collect taxes on 2 things. We're going to be able to lower the tax rate on labor from 300% to 100% because we're going to start taxing machine use, which we were giving away for free, right? The old rate was 0 on machine hours, and now it's $40. So this first set of assumptions here, where it's $100 of labor and 3 machine hours, this is a job that is pretty labor heavy and is not using much machine time, and so it is going to see a tax cut. On the other hand, here we have a job with 100 labor dollars and 8 machine hours, and it's going to see a tax increase because it's a heavy machine user. Somewhere in between these two, you'd think, God, there's got to be some type of job that will be unaffected by these two. And actually, it's mathematically, it's really easy to show that that's going to be one that uses 5 hours of machine time for every $100 of labor. Well, first, let's just do the math to see that that's the case. 5 times 40 is 200, plus 100 labor dollars at 100% is 100, and so 200 plus 100 gives us 300, which is exactly the cost we had before. The interesting and important part is, why is it $100 of labor to 5 machine hours? The answer is in the activity bases. The average job, if imagine we only had one job, what would it look like? Well, that we just did over and over and everything was exactly the same. Well, it would have a ratio of 400,000 direct labor dollars for every 2,000 machine hours, and if we divide 400,000 by 2,000, that gives us 20 labor dollars for every machine hour, which is exactly what this last job has. 100 to 5 is a 20 to 1 ratio. If a job uses inputs in exactly the same proportions as the activity bases, then it is not going to be affected by a change in the accounting system. It's just like you've taken that one taxpayer who makes just enough, right, you know, the tax cut. The tax cut on the only thing that was being taxed before is exactly offset by the tax increase on the thing that wasn't being taxed at all. So this ratio is called the balancing point, and the balancing rule is what I stated before, that if you don't, if you use the drivers in exactly the proportion of their activity bases, then you will not see a change in the overhead allocated to your job. Okay, so one last thing before we end, I just want to introduce two terms. The first term is hidden driver. As I've said, in this situation, this company had machine hours actually driving overhead, and it was hidden by the old system. They were giving the overhead, the machine hours away for free. They weren't being charged any overhead whatsoever. So the new system revealed a hidden driver, machine hours. It's also possible that you can have a hidden difference. So imagine we had essentially the same situation, but it wasn't that there was labor and machine hours. It's that there were two types of labor, and labor in Department 1 was not driving nearly as much overhead as labor in Department 2. Okay? That would be a hidden difference because you would expect to see a difference in rates, predetermined overhead rates for labor across the two departments, but it was hidden in the old system because we were taxing every labor dollar at exactly the same amount, 300%. And maybe what it should have been is, 150% in one department and 500% in the other department, or something like that. Okay, so it's a hidden difference because actually every labor dollar was being taxed before at 300%. We were just not recognizing that we ought to tax some at a lower rate and others at a higher rate. Okay? Whereas in the case of the hidden driver, we weren't taxing machine hours at all. Okay? They were getting off scot-free, zero taxes completely. And that's the difference between a hidden driver and a hidden difference. The point of two-stage costing is that by splitting all of our overhead into multiple pools, we're going to get a much better look at the true amount of overhead driven by each product or service we provide, which allows us to isolate margins more effectively. Okay? So I hope you found this an illuminating discussion of two-stage costing, a central tool in more intelligent allocation of overhead, and I hope you'll take a look at the other videos. Thanks a lot, and bye-bye.